everybody. This is Fred Meissner with the Fred Report Technical Conference Call for November 11th, 2010. We're in Nashville, Tennessee for a seminar, so we'll get right into the call. Want to wish everyone a good morning, and we'll take a look at the market first. The stock market is trading a little bit choppy here. We actually really like this action. We note that yesterday's action basically filled the gap on the spiders around 1200. We think we can trade as low as 118, 119 and still be in a very nice uptrend here. We may not even do that. The market looks pretty strong overall. We note that we've got still leadership in the tech sector. The Qs are looking good, the QQQQs. We like the looks of the mid-cap and the Russells. We would have to say that the leading sectors in the stock market are technology, materials, and discretionary, and the lagging are still some of the defensive ones, and we think interest rate-related ones like the XLU and the XLF. We think that in a year-end rally, everything is going to rally, including financials, but we still continue to have fears that those stocks and groups are going to underperform. When I look at some of the stocks in that area, and we'll talk about those later, there still is a fairly good sign of underperformance. The sector report is coming out this weekend. We may be making some changes in there in terms of our weightings and such. So we will so take a look at that when it comes in and realize this kind of choppy stock market now, even though stochastics and stuff aren't coming down that much, my own personal indicators are coming down. This actually looks like we're setting up for a fairly strong week next week for options expiration the way we're trading right now. We're going to switch over to the bond market here for a minute. We note that the TLT came down to our target area of 96, shot below it, and then closed back above and closed positive. This is an inverse Prussian helmet formation, or spike, which is something which is generally short-term bullish. We would note that if we do start to see closes below 96 on the TLT, that targets 94 on the downside, and then possibly 90. But actually, we think we're oversold enough here on the TLT to at least stage some kind of rally. We would not be short the TLT anymore here, at least without a rally, unless we're willing to undergo a rally while we're short. Where could a rally take us? Rally could take us to 100 on the TLT, possibly 102, and this may be setting up a bottom in this Treasury bond area for investors. It is not a bottom yet. It's a high-risk buy. If you wanted to try to buy the TLT with a stop below yesterday's lows on the TLT, that would be the way to do it. But except for the most aggressive speculators that we have out there, that's not the way I would handle that situation. I would just sort of stand aside this market, sort of see what we do. And note that, again, if I were buying bonds for clients, I would be looking at the LQD, the corporate bonds, as that area looks a little bit better. We note that the BWX has come down to support. That's the international bond ETF we follow. If it breaks the 60 area, that could go down and test a gap that's in the 57, 58 area. There is a small gap down there. And we do think when we get into comments on the dollar that the dollar is an intermediate turn downtrend. So that, again, is a little bit more of a risky play. But actually the best risky play, if you're searching for yield, is to keep a look at this HYG, which has come back down and is testing the breakout at 90, just as the S&P has come down. If the S&P holds this HYG, which is high yields, is probably going to turn around and rally to the 96 area. And that, I think, is a fairly good speculation and a good bet. Let's talk a little bit about the commodities area. Gold has not had the kind of pullback we would have liked to see. There's still a big gap on gold, but also still a very strong uptrend, and we think that the kind of action we're seeing this week is setting up a rally into next week. We still have our 15, 20 an ounce, 18-month target on gold. That comes out to around 152 on the GLD. And we note that seasonal strength in these commodity markets start to kick in late November. So seeing the dollar rally now, which is going to put pressure on these commodities for erroneous reasons, by the way. There is no real correlation long term, but we should see some pressure on these commodities. We would use that as a buying opportunity position for a move into the end of the year. Speaking of the dollar, let's take a quick look at the dollar. The dollar index, DXY, we published charts on that a couple of times over the last few weeks. We think that there is a bottom forming on the dollar for a trading bounce to the 81 to 82 area, but that after that the intermediate term downtrend should reassert itself. On that move up, one of the telltales is going to be the Japanese yen. The FXY has come down a good bit and could actually be weaker than the euro here, short term, but stronger longer term. We do think that the FXY can trade down to 117 if the dollar gets the kind of rally we're talking about. We note that the euro has broken an important support level according to CNBC, but it's actually not the support level we have, which is 132 on the FXE. They're saying basically 136.5 is important support. It's really not to me. It's much more important to hold 132. I would like to see the euro come down and test that. If we do that, you're likely to see the dollar rally to 81.82, like we said, and then come back down and stabilize. And it's important to remember for year-end seasonal commodity strength, we could see the dollar stabilize completely and commodities actually rally. Just a quick note, we didn't mention oil, so we're going to mention oil right now. We look at the USO and another one that we like the looks of, DBO, and we note the DBO is actually performing a little better. There's some rolling issues that they mitigate with that ETF. This looks like a head and shoulders bottom. We'll go back to the USO since that's what everyone's familiar with in terms of our analysis. If the USO can stay above 36, and it's at 37.93 right now, we're looking at 42 to 43, and that will target oil in the low 90s. And we do think that that's going to occur, actually. So that area looks good, and we'll talk about a couple of oil stocks in a little bit. First of all, let's talk about some stocks on our on the list and stuff. We